Got a new CPI report showing that super core inflation, which takes housing out, has actually come down despite the headlines that yesterday's CPI print came in hotter than expected. What does that mean for the economy, inflation, interest rates, and real estate? We're going to talk about all of that and more today on the Gray Report. And that more, we're going to be getting into new report from Paul Fiorilla, who we interviewed on the Gray Report just last week, of Yardi Matrix, digging into all these multifamily loans that are maturing. We've seen them kicked off, and now 2025 is the year where we have a massive concentration of loan maturities. But does it matter? Let's talk about it. And then lastly, from the Harvard Joint Center for Housing Studies, piece looking at power to the neighborhoods, looking at this dynamic between development in cities, neighborhoods, NIMBYism. How can we supply the nation with enough quality housing stock? That and more on the Gray Report. So if you're an active investor, passive, active, you're in the industry, this is the spot for you. Gray Capital YouTube channel every single week on the Gray Report. We're breaking down all the latest research, data, articles, and including some original opinions from the Gray Capital team. I'm joined by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. We're live in the Gray Capital studios in sunny Indianapolis, Indiana. Let's get into it. Welcome back to the report.
Hello,
Matt. How you doing?
pretty good. This was a really efficient. This was an efficient week. It seemed
Yeah?
like things are
That's good.
really almost like clearing up, and
Yeah.
I'm almost like, is this normal? Because I'm not too happy, which is a little scary.
Okay. Yeah.
Economy's not overheating. There's some solid signs that I could get used to this. That's something.
I don't even know what this is, Matt, but
Yeah.
I don't disagree. I don't think things are getting necessarily worse, but I think there's still a lot of potential dark clouds out there,
Yep.
and there's some uncertainty. But yeah, I think the clouds are clearing
Mhm.
a little bit. And let's just get into this, Matt. Inflation. I mean, the one big headwind for real estate right now is interest rates. Interest rates, led by the Fed funds rate. They're not going to be coming down too much until
Mhm.
inflation shows some real progress towards, I guess, confirming that it has slowed and easing. And
Yep.
as Jerome Powell will say that it's getting down on its way to that 2% target. I don't think it has to be at 2%, but it needs to be moving in the right direction. Well, the kind of the year over year number came in a little bit hot at 3.1%, Matt. We're trying to get down to 2, but my thoughts when the CPI print came out yesterday, Matt,
Mhm.
is I don't know if I care much about CPI anymore.
Yeah.
The methodology is so off. The Fed's looking at PCE primarily anyway. The way
Mhm.
that they measure shelter inflation is just not a great methodology.
Yeah.
And it overinflates shelter. And it's such a huge component, 36% of total of CPI.
Yeah.
And it's confounding. We don't really understand why it's
Yeah.
reading
Yeah.
what it is. And so what's the real point? Because
I had
you
a big
take
question
shelter,
mark
if
this
you
month
take
for
shelter
sure.
out, it's not even that big of a deal. And so, the 10-year
Mhm.
treasury jumped yesterday, not a huge amount. It'd been lower. It popped back up. But, do we really think inflation is taking off? Because here's what I hear. The economy is,
Mhm.
doing well.
Yep.
Really strong.
Mhm.
But then you hear people saying that things are slowing down
Yeah.
moderately,
And if
and
they're slowing
concerned about
down-
real slowdowns.
Yeah. Yeah.
If we're slowing down, then inflation's not going to be a problem.
Mhm.
It's two really diverging opinions, and I think some of it is how people feel in their past experience over the last couple of years versus what's happening today and what's going to be happening over the last
Mhm.
or the next couple months. But what's your take, Matt? You've given a closer look than I have.
We talked about stagflation. That's like the specter of both like a bad economy and inflation. I don't think we're headed towards that.
Are we having the opposite of stagflation? Because we're seeing low unemployment.
Mhm.
We're seeing some growth, but
Yeah.
inflation isn't actually picking up as much as we thought. Because stagflation is like inflation is high,
Mhm.
but growth is low and unemployment is high.
Yeah.
But we're not. So but we're seeing decent growth, moderate inflation, and low unemployment.
That is kind of scary. And I noted in this jobs report, it's like when the unemployment rate is this low, that's usually like the beginning of it spiking back up again.
Mhm.
There's so many things about this economy that seem to balance against each other. Like just kind of getting into this, the recent job report, which I lumped in with this one.
Yeah, I noticed that.
The job
Which is good.
report was fairly strong, but it had some like but there are ways to look at it where, well, I don't know, the unemployment rate
Well, because
maybe.
wages are starting to
Mhm.
growth rate of wages is tempering a little bit,
Yeah,
which is
yeah.
positive for inflation. Obviously we want people's wages to go up, though. There's
Mhm.
always a push and a pull. Um,
But I mean, the assessment of the
yeah.
job report was, the base numbers were fine. There was less private sector employment, which is kind of trending down and has since early to mid 2021. Not bad, really not good. Nothing to get too excited about.
Well, I think that's the question. Is what I've heard from a lot of people is how much of this growth is government spending and
Yeah.
fiscal
Hmm.
stimulus. And now that's not anything new to the United States or any country, but we'd feel more confident, we'd feel better about it if the growth in the jobs were coming from the private sector rather than, via fiat
Hmm.
funded through debt through the federal government or
And
the
there's
state
some
governments.
question too about how much of the jobs are part-time jobs, how much are government jobs. It wasn't like a rousing, a huge the numbers of jobs weren't big enough to kind of quell any misgivings about it, but they definitely weren't low enough to say, oh, ah, man, jobs are going down. It wouldn't get past the headline. You know what I
Yeah.
mean? So not a whole lot of bad headlines about either, really.
So if it's like, let's say it's sort of being propped up by the government,
Hmm.
but that means that growth is actually a little bit slower, which would
Hmm.
be from the standpoint of we're hoping that interest rates come
Yeah,
down.
yeah.
That's a good thing, though,
Wherever you
right?
go, you can find a good way to spin it. And what's funny is I looked for, especially for the CPI, I looked for bad articles about it. I mean, all right, it's a Biden administration. I'm going to look for like right wing takes on it, and they weren't as bad as I thought. I was like, these guys could really dig in and really find something, an
I,
indictment of the current economy and the current administration, or whatever it
I
is.
just think we're all going to, I think we're going to be appreciating the Fed's longer term view of these things.
Mhm.
And the media, obviously, we want to have taken a knee jerk reaction to the latest data point.
Yeah.
And the latest data point is, the absolute direction that we're going forever.
Yeah, that's true. But I was surprised that there was a muted response. Now,
Yeah, everyone was like, kind of like, okay,
we
yeah,
could,
well,
in the next couple of days, people could, crunch these numbers and say, oh, actually, no, this is the real hidden terror inside these CPI numbers. But I don't really feel like initially, and the stock market didn't, they're jumpy as anything. And stock
yeah.
market didn't do anything really in response to the CPI report. So I think that, I think that this may go, I was surprised. Maybe people are like being reasonable and they're like, oh,
Oh
well, look at
no,
rate.
no,
Yeah, you're right. You're right. Sorry.
just stop. That's just where you're wrong.
I can give this like, all right. So last year, inflation followed a fairly clear linear path downward while rent growth fluctuated and stagnated. This year, I think we're seeing inflation in a similar wobbly and uncertain path, this kind of bumpy road to normal or
Yeah.
whatever. And rent growth may not be as clear and positive as last year, but it's certainly more coherent
Yeah.
than last year. The latest CPI, you mentioned this right now. It showed total inflation up 3.2% year over year. And that is up slightly from last month's 3.1% year over year. And the monthly numbers for total inflation are 0.6 month over month, whereas last month was 0.4. So up on both counts. And core inflation is up 3.8% year over year, slightly lower than last month. And um, I'm sorry, for the monthly core inflation was the same as the total, which is actually up 0.6% compared to the previous month at 0. So a little bit of a wash, but it is ticking up slightly. That's not good. But on the whole, 0.6 monthly inflation would have us closing in on like 8%, 7.2%, whatever. That's a lot for the year. So we
Yeah.
can't have 12 months of this.
No.
But on the whole, again, not a whole lot of hand wringing on either side, outside of internet personality and sometime aficionado of bright green hair. Meet Kevin, who calls the CPI print very, very asterisk bad, and notes that what was mostly concerning is that the trend of services inflation is moving sideways and if anything, maybe starting to move up. And this is a comment that he manifestly does not really prove in his video, and one that really collapses under a moment of scrutiny. I don't profess to have Meet Kevin's expertise at technical analysis or spreadsheet wizardry, but definitely services inflation is not going sideways this past month, and it is going down. Services inflation did go up in January a little bit, but it is still going down, and that's been the trend since 2022. Really, it's the only time it's ticked up. I'm sorry, since February of 2023. So it's really kind of disingenuous to say that services inflation is starting to move up. It's very clearly going down, and I'm really confused on how to fit an apocalyptic take on the CPI with the assessments from the stock market, economists, et cetera. I think that if you're going to be alarmist about it, you can. But I really don't think, not even in services inflation, is there really cause for alarm. This is one of those times where whatever trends are happening, they're kind of still forming right now. And if I'm going to fall back on something, I'm going to fall back on the general trend of the previous month, and again, not what you said, just a bump here or there. And sometimes there's not even a bump. So if you have to,
I think there's just not. It doesn't mean a whole lot without more data.
Yeah.
But one thing I guess that we do know more or less is that we made a lot of progress over the last year or so on inflation, and then we've gotten to a point where that progress has slowed down a little bit.
Yeah.
But we also know Jerome Powell said that they don't necessarily need to see much lower numbers. They don't need to see better data. They just need to see more of this data that we're kind of in this range. I think we're in kind of an acceptable range, but it's becoming more consistent. But I mean, the general trend, if you're zooming out, I mean, we're moving in the right direction. I mean, I think that the anticipation there would be a straight line down, no one really ever thought. And I think it's this conversation of the last mile being tough, but I think that there's a little bit of pushback on that of saying, okay, well, what's preventing us from getting down further?
Yeah.
I think though it does give a lot of credence to the idea that do not expect a rate cut in May. It's just probably too soon. We need probably more of this data. And I don't listen to a lot of Meet Kevin anymore, Matt, but I did listen to a little bit of that clip that you mentioned, and even in the clickbaity part of the video is that it's a bad report, and that means the interest rate may be going up or staying high. He's still saying that likely to see a decrease in the Fed funds rate by July. Which is I'm like that kind of makes sense. I'm like I track that. Now he makes the I think appropriate point that we can't be confident of what that decrease is going to be. If it's going to be probably 50, 25, 12 and a half. Basis points, and they don't necessarily have to do more than one. They can do a little one and see how it goes, just to see how the stock market reacts. Does it go crazy and does it start to overheat?
The comments section on that video was saying, "Oh, the Fed, if they knew anything, they'd be increasing the interest rates, right?" So
one could make that argument. I mean, one could make that argument. I mean, unemployment's still low. Housing is still going relatively strong. Different measures, obviously. There's issues, here and there, but like home prices are still up. Again, wages are still growing. Inflation's still moderate. You could say that they have the argument that look, raise the rate. You're not in restrictive territory because you haven't seen things coming down. And you need to push a little bit harder. I think the same argument could be you could just leave it where it is for a little bit longer also. But, do you need to? But if you take some of the noise out and you do see things slowing down, if you're in the camp that, okay, the economy's slowing, if you're the Federal Reserve, you're looking at that risk of leaving those rates too high for too long. And then you do cause some unnecessary pain if the economy is working through and kind of healing itself.
That's
and the
assumption.
Federal Reserve's mentioned that there needs to be a lot of healing, specifically that word healing.
And it's hard to heal when you got interest rates this high.
That could throw, again, psychology is the primary tool of the Fed. And that would be a major pivot because they've been communicating that, they're not giving a time, but rates are going to be coming down. To make that pivot would communicate that inflation has really changed gears that they need to take drastic action, and that would kill probably the stock market. There would be a ton of economic pain, at least psychologically, but
Just if
also
people knew that it was staying the same.
yeah,
Right.
because again, the entire banking system and all these real estate sponsors and investors, they're doing, instead of a rain dance, they're doing like an interest rate, ceremony to try to, hope some seance to try to get rates coming down.
Yeah.
They're hoping it's going to be sooner rather than later. Their lenders saying, hey, we're not going to foreclose on you yet because we think rates are going to come down. And so you're going to be a good guy here and we're going to give you some extra time. Then all of a sudden, if the Federal Reserve's like, guys, no interest rate decreases, we're going to raise interest rates. It would be like when we brushed 5% on the 10-year treasury when everyone's like, all hope is lost.
Yeah.
This is bad. And rates may keep going up. That was a major shift in the economy. But then we reverse course. So anything's possible. I think the likelihood of them increasing rates is very low because I think that risk of really wrecking the economy. Yeah. Even though that was like the first thought that they had. They thought that were going to have to do that. If they can achieve anything close to soft landing, they're going to try to. Yeah. They've got that in their sights. Yeah.
That's it. No, I think so too. And really to get back to the CPI a little bit, skipping to the rent of primary residence section for a moment. I was surprised that this figure went up on a month-over-month basis. Not really what I was expecting. Went from 0.4 to 0.5 month-over-month increase. But if you look at the year-over-year numbers for rent,
it doesn't look like an increase.
Well, that's the year-over-year. So if we did if it was a month-over-month, it would show slightly different.
Year-over-year. Well, okay.
But it is still like the strength of this trend that just washes away any of this monthly variation. So it's a little bit promising to see such a linear fall.
It's all how you look at the data.
Yeah.
Right.
Yeah. And that's another thing too, is like, you can fudge your numbers and pick your time period so that you see a trend where maybe a trend isn't. And what I'm saying now is, even with that in mind, if I have a take, it would definitely be that like we're not in a situation right now where there is a clear doom, a clear negative trend in any of these inflation numbers.
Here's the month over month. I mean, what did I do here? Here's a month over month, Matt.
Yeah, so it's a
little spike up, but I mean, again, that's just the little spike. It's the trend is pretty clear. Again, it's not going to be a linear line. But it's nothing like this little spike up that we saw back in September. Yeah. And then we continued to drop back down. And again, we've seen, we know, again, this is why it's frustrating, is because this is looking back into the past, up to 2 years, and we know exactly what rents did.
Well, yeah, you can pull up there's that apartment list image on the next tab there. It shows how much of a lag, how much we have to wait. And it's really, looks like a year and a half. We did studies of this where it said like 13 months, and it seems much closer, just looking at this and glancing at it, than closer to a year and a half than to 13 months. So we are just in like, maybe if halftime is the peak and the fourth quarter is the trough of this, we are pretty much in the start of the fourth quarter. Yeah. And we got one.
And so this is why it's frustrating, Matt. And where I'm like, why are we even looking at CPI? It's because, they're saying that, well, shelter costs, rents are just still high. Rents are still growing. That's why CPI is up. That's why inflation is up. Yeah. But we know, because this is the business that we're in every day and the industry we're in. And literally part of our jobs is tracking this information and seeing where rent growth is nationally, regional markets, local markets. We're doing this podcast every single week where we're talking about it. So we've got a pretty good pulse, where rent growth is in this country. And so we know what rent growth did last year. It was negative. Yeah. And there's never been any negative number on this shelter.
Yeah. Yeah. And frankly, I don't expect that for some reason.
Never will be, right?
Yeah. The smoothing effect of the CPI measured inflation never really gets the extries.
But shouldn't it be
trackers
lower? Shouldn't it be
definitely
low?
Should be lower. It's like halfway in my.
Should it be 3? Like year over year, not 5 or 6.
What is it showing on this apartment list? It says 6.1%.
Now that's 6%.
Now that's probably like last.
No, but I just calculated for this one. It's like similar. 6%. It's over 6%.
It really should be closer to.
It's not rent growth. We're growing 6%. I mean, that was 3 years ago.
Yeah. Um,
I understand, there's some smoothing out and
Yeah.
and it's not same store data and it's an equivalency. It's not even direct rent. And again, shelter makes up 36% of CPI.
Yeah.
And so I'm just saying, what decisions are being made off of this? And that's why, we look at, and other folks are looking at this super core inflation, which is, less basically stripping housing out. Where's our
See
super
that
core?
last
Oh, yeah.
tab there.
Oh, we don't have a chart.
Yeah.
But the super core inflation is coming down. It's basically slowed to 0.47 on a monthly basis. Let me share the screen so people can see.
Down from 0.87 looks like.
Yeah. So the super core, again, stripping out housing. Yeah, it declined to 0.47 compared to 0.87 in January. So again, a little nuance, but let's be real. Okay, the rent, the shelter figure in CPI is meaningless. It doesn't mean much for us if we're looking at where inflation is today. So we take that out. Inflation's coming down.
Yep.
And the Federal Reserve, they are nuanced. They understand that. They're the ones that were looking at that metric. They look at PCE more than CPI.
They look at private rent growth trackers.
And they were looking at private rent growth trackers because sometimes the government agencies shut down.
Yeah.
But they know. They know. They know. And so I think they're seeing this as noise rather than signal.
And ultimately, the real jump in the CPI this month was because of gas. Gas prices went up 3.8% in a single month. And that is after going down 3.3% in the previous month. So it's like, call it like a 7.1% swing in the positive trend for gasoline. And that's a pretty big swing. Yeah. And not only is it like, what was it like among the most, the biggest categories of increase, like it also is weighted fairly heavily. I mean, not like, not like rent.
So CPI report, nothing burger, but actually looking at the details, I think it's actually a relatively positive sign, almost like a no change.
Yeah.
Certainly
I could get used to this.
Get used to just the long slog, and it's going to be any rate decreases are going to be second half of the year, third, fourth quarter ish, closer to the end of the year. Don't count your the eggs before they hatch, or the chickens before they hatch.
Especially with these inflated egg prices. No, that was last year. Sorry,
that was last year on the eggs. Yeah. So anyway, I want to get to this Yardi report because it's something we've covered over the last year and a half. Are all these multifamily loans that are coming due, Matt? They're maturing. And they bought at peak prices, 3% cap rates. They put, max out leverage, 80% loan to value on a short-term bridge loan that when it started paying, it was 3.25%. Now they're paying 8%, and they're not getting the rent growth. They've gone to their lender. They said, I need to refinance because my loan's maturing in 6 months. And the lender's giving back their proceeds, and they say, the proceeds that we will give you are less than the original loan balance. And in fact, your original loan was $10 million. Well, you actually need to come to the table with $14 million if you want to keep the deal.
Oh, okay. Yeah.
So that's an example, but that's what's going on throughout the country right now in the multifamily industry. It's not materialized to a ton of visible, I guess, like foreclosures and distress, although there have been some high profile foreclosures and distress. What it's materialized into is sponsors running around issuing capital calls. What's happening today is the attempt they're trying to save the deals. They're trying to come up with the money to meet that.
This is the moment.
The difference. I don't know how many investors I've talked to, Matt, over the last couple of weeks, because we're raising equity for a project. If you're a accredited investor, hop on to greatcapitalllc.com to learn more about it. I don't know how many conversations I've had with investors who are dealing with a current capital call.
Yeah. I can't invest with you. I got to throw this good money after the.
Well, and that's what it's a tough decision because one, you have to address and analyze whether you're throwing good money after bad.
Yeah.
And that's a hard conversation to a sponsor because you're basically saying like, you have to be unemotional and be like, all right, I'm writing this one off, but it's hard to call a sponsor and say, who is desperate and they need you to come in and they're like, you're a partner on the deal. I need you to step up. Everyone else is going to step up, which they don't know that. Yeah. And then to say no, I don't have any faith in you or the deal
Yeah.
or the market. Like, best of luck. But, I'm going to stay in the deal. If you get to do the capital call, I'll be
Mhm.
diluted. But, that's better than doubling my investment and doubling my loss.
Yeah. Yeah.
If I get diluted and, there's no way the deal's going to earn up to 15 IRR anyway.
Mhm.
Maybe I'll get my money back. I'm not, this is never going to be a big return anyway. I just want to get my money back. I'm
Yeah.
not going to give you more money with a
Yeah.
chance of losing double my initial investment.
Mhm.
Um, that's a tough conversation just personally, but some
Yeah.
people don't want that type of conflict and saying no, but like it's your money and you have to make those tough decisions and
Yeah.
just say, I'm going to write this investment off and I'm not going to. So you've invested $100,000. You have the choice to either try to save that first $100,000, but with a low likelihood that you'll get any of it back, you'll lose a full 2,000,
Mhm.
or do you invest into a new deal looking to double your money? And so at the end of the day, you write off the 100,000. Maybe you get that back, maybe not, but you have at least a better opportunity to double your money, at least get back to even.
So investors have a choice to not participate in the capital calls.
Every operating agreement can be written differently. Usually, um, there's a choice
Mhm.
of you are being asked to make a capital call. It can be worded like it's an obligation, but with consequences if you don't.
Yeah.
If you don't meet the capital call, you'll be diluted typically.
Mhm.
It's usually not like you're getting kicked out of the deal, although you could write an operating agreement where you're required to make a capital call, just like if you were investing into a fund
Mhm.
that had a series of
Yeah.
planned
Okay.
capital
Yeah.
calls. You're signing up, got to make the capital call. You've signed the contract.
Yeah.
You're in the partnership. So you could write that into a one-off deal, but typically is not because
Yeah.
investors want to at least be able to say yes or no.
Yeah. Yeah. Things
And
usually go
sometimes they're
bad.
capped. Sometimes, a lot of times they're capped also. Like you can't call more than 25% or 30% of the
Okay.
outstanding capital.
Yeah.
So an investor knows, okay, well, if they do issue a capital call and if I do meet that, I'm only, I'm only contributing 25% more rather than, if they did 100,000, a full extra $100,000.
Yeah.
The problem with that though is these sponsors often need more than 25% of the original capital. They may need
Yeah.
50% of it and maybe even more. And so
Yeah.
if there's that limitation,
I'm curious about whether so then you say no to the capital call and the sponsor doesn't get the 25%, maybe they get the 10%, or maybe they get 10% extra or something. What happens then?
if they can't raise the
Does
money.
that person that say no, do they then, if everyone says no, then the investors are probably maybe getting like 2/3 of their money back or something like that if it's a bad deal?
Well, so in the case, what you're saying
Mhm.
is the sponsors issued the capital call and
Yeah.
not all the investors meet it and they don't have the money
Yeah.
to refinance the loan
Mhm.
and bring enough cash to close the deal.
Yeah.
So that's the situation that a lot of folks are in right now because one, some investors don't have the money.
Mhm.
If you're in multiple deals and they all have capital calls, you may not have all that money laying around.
Yeah.
You may not want to do it like we were just talking about. So in that case, the sponsors are going to have to ask some tough questions or face some tough decisions.
Yeah.
What a lot of people are looking towards is, there's rescue capital out there.
Yeah.
And so the most probably common thing right now is pursuing some preferred equity. So you bring in some preferred equity for a chunk. That way, their upside is limited. They're going to get a bigger return than your LPs from like a preferred return standpoint, and they're typically going to be in a priority position. It can be, it's a tool. So, it's all how you use it. Right. And preferred equity can look a variety of different ways. In an ideal world, it provides the necessary capital to bridge the gap, to get on the new loan, turn the property around, and then, you refinance or sell the property in 2 years and you pay back the preferred equity investor. They get all their money back. They get their money out and your investors make some money. But it also could go where the preferred equity investor comes in and the property isn't able to be turned around. The market doesn't improve. And then they have to sell. And maybe there's only enough money to pay the preferred equity investor back. And then the LPs get nothing.
Okay.
Or maybe they get a little bit. But that preferred equity investor has to be paid their full preferred return and all their money back before the investors get a dime. So it's like, hey, we're bringing in preferred equity to save the deal. So, we live to fight another day, but that fight the next day is not, the success is not guaranteed.
Yeah. Wow. So it could, now I'm not saying that this is really what happens, but it could be a case where you're trying to save the deal by doing preferred equity, but actually you're making it incredibly more risky for the investors.
Yeah. Yeah. And then certain preferred equity shops, people are issuing preferred equity.
Hmm.
Some of them just want to, decent return. Like we have a preferred equity program. And so, we're just trying to get decent returns
Hmm.
and help some deals.
Yeah.
Other preferred equity is much more vulturistic. And I don't
Hmm.
necessarily mean that in a bad way, but they're going in there almost hoping that the deal goes south.
Yeah. Yeah.
Because preferred equity often also has some major decision controls, maybe
Hmm.
even some takeover provisions if it's not, behind an agency loan,
Okay.
where, if you fall behind, the preferred equity investor can take over the deal.
Okay.
And so some people are, wanting to write that preferred equity check saying, I hope the deal kind of does go worse.
Yeah.
And then I can just squeeze you out and take the whole deal from you.
Wow. Okay.
So
Okay.
yeah, you gotta be careful who you're partnering up with.
Yeah. Yeah. Well,
But
and
desperate times, people,
yeah,
choose desperate measures sometimes.
man, that's crazy. And it almost gives a little bit of like threatening leverage during these capital calls. It's like, well, it's all right if you don't take that capital call. I will pursue some preferred equity options. It may make things a little more risky, but that's what happens if you don't do the capital call.
There's a lot of
Yikes.
customer service and diplomacy.
Yeah, yeah, yeah. Say it with a smile on your face.
And advice too, because I know a lot of sponsors listen to the Gray Report. A lot of multifamily investors, but sponsors.
Mhm.
You have communication is key.
Yep.
Just be transparent. Investors, while they could be upset, usually are relatively rational people.
Mhm.
And, they made that decision to invest in that property as well. And so sometimes it's unfortunate, but sometimes the deck looks flashy and you do the deal.
Mhm.
I think there's a feeling of like, darn it, they're frustrated at the sponsor, but
Mhm.
there's also a kind of feeling of like, oh man, I made the wrong bet here.
Yeah.
I chose, either I invested, and maybe I picked the wrong horse. I didn't
Mhm.
invest with the right group, but also there's a like, geez, no one could have anticipated that interest rates rose the way that
Yeah,
they did.
yeah.
And there's a spectrum of, I think, responsibility of there are good operators with good deals in good markets that
Mhm.
just got caught with interest rates getting crazy.
Yeah, yeah.
And they weren't necessarily over leveraging or being too aggressive. Again, it's just it's an extreme situation between interest rates and supply dynamics. I
Yeah.
mean, no one in the Sun Belt thought rent growth was going to go negative or even
Yeah.
slow down. They
Yeah.
thought that maybe it would moderate a little bit, but
Mhm.
no one was thinking that. So you would have had to be so far away from consensus and cutting against the grain. You probably wouldn't have been doing a deal.
Yeah, yeah. Well, no, thanks for especially for that breakdown of kind of like what does this mean on the ground level for investors and for sponsors, the kind of hard decisions that you have to make
So
when you're
just let me
approaching
finish.
these
So
things.
just to finish my point, you have to communicate.
Yeah, yeah.
So if you're a sponsor, you have to communicate with your LPs throughout the process of just here's where we are in as early in advance as you can, and
Mhm.
just that. And I'm going to be done after this. But
No, it's fine.
No, but I don't want to interrupt
Yeah.
you. But we had one of our property, the only one that we had that we were even close to having an issue a capital call was
Mhm.
property Forest Ridge down in Bloomington. Because we bought it on a bridge loan when interest rates were still really low, but we bought it first off, got a great deal on the property itself. And we did a value add when there were a bunch of leases that were expiring. Got
Mhm.
in there, we renovated the units really quickly. Went from 80% occupied to, 100% occupied over the course of a couple months.
Mhm.
But through that process, we're getting quotes from lenders to try to refinance because
Mhm.
we know our
Yeah.
loan's going to be coming due in like the next 9 months. And, at first, all of the quotes that we got said that we were going to have to bring an additional like $600,000 up to like $1 million
Yeah.
to the table to close. And also all the deals that we were hearing about, they were all cash in refinances. Where before, I'd never even heard of a cash in refinance. It was
Yeah,
always
yeah.
you were pulling cash out. It goes
Yeah,
the other
yeah.
way. We had the team. I mean, we had some really strong occupancy and NOI
Mhm.
goals and objectives. And so we were able to push occupancy. We got to 100% occupied. We really increased NOI significantly.
Yeah.
That eventually led to us getting an appraisal showing an increased value at the property of $5 million, which
Mhm.
all the appraisals right now are kind of all over the board because
Yeah.
they don't know what valuations to use. But we got about $5 million value increase. And where our income was and cash flow, it allowed us to get a loan, a fixed
Mhm.
rate agency loan that actually allowed us to pull a couple $100,000 of cash out to fill back our reserve coffers.
Yeah.
But that was on the margin. That was a deal that
I remember that
that
was
we
like
executed like really well
yeah.
because we got it fully renovated and leased back up really quickly. We were able to push rents. That was like everything went swimmingly and perfectly.
Yeah.
And then for a moment, we were still going to have to bring cash to the table.
And you hit, I think it was Forest Ridge. You hit the right moment, right, for the refinance.
Yeah.
Yeah.
Yeah. We got a little dip
It was
in,
like
in rates.
it was like
nice.
a 1 week window or
It
something.
was great.
Yeah.
Yeah. I mean, when the 10-year was down to 3.8 or 9. But what we did, even when we didn't know, we started having conversations 9 months prior to when we got the refinance with
Yeah.
our investors, and saying, "Here's the situation. Here's where we are. Here are our quotes. This is the potential situation."
Don't say that. They're gonna get mad. Did they get mad?
No, no, no. Well,
I'm
they
just
were
kidding.
they were like, obviously not pleased
Yeah.
that,
Yeah.
or they were not like really happy
Mhm.
that we were possibly looking at this situation. But we came to them with a plan. I also said that, like, look, I'm looking at, I will cover the shortfall.
Yeah.
I'll do a member loan to the company. I'm not even going to ask anybody to do the capital call.
Okay.
This is the plan.
Yeah.
Now, obviously, and then what I was going to offer is I'm willing to put up all the money for the capital call,
Mhm.
but I'm going to invite the other investors if you want to participate in the member loan.
Okay.
Because, and again, we're going too deep, but capital call and a member loan. Capital call is equity in. A member
Dilution.
loan
Yeah.
is just, and then the equity gets diluted if you don't
Mhm.
participate. Versus a member loan is any member of the company can loan the company money.
Okay.
And there's typically an interest rate. Oftentimes it's the rate of the preferred return, and that it can be subordinate or not subordinate to the
Mhm.
preferred return. Sometimes it can just accrue depending on the situation. But I was basically saying, look, like,
Yeah.
I'll take the position, but there's no upside, so it doesn't dilute the rest of
Yeah,
the
yeah.
investors. But it's saying, if you want to, but the interest rate was going to be we're actually considering being like 10%, and so
Mhm.
like you can come into the deal basically like almost like internal preferred equity with no special rights.
Yeah.
Come in the deal, earn 10%. You don't need to. I'll cover it.
Mhm.
But then what will be, we'll be in a good spot. This is the plan.
Yeah.
But these are all things that we're going to do to avoid this from happening.
Mhm.
But if it does happen, this is how we're going to get out of it.
Yeah.
And I've got it taken care of.
Yeah.
Wanted to let you know. And love that your opinions,
Yeah.
advice,
Yeah.
suggestion, just because I want to be transparent.
I was joking there about don't say that, obviously, but only because people do that because it's easy to not communicate because it's easy to say things are going okay and then wait those 9 months instead of saying something. And people have done it, and we see Washington Post articles about it.
People don't like being surprised, and if things are like going a little bit worse, and you say things are just fine,
Mhm.
and things get a little bit worse, things are still fine.
Yeah.
And then things get like a little bit worse, and to a point where it's bad.
Mhm.
And then you have to say you can't. Then your numbers aren't looking good, and you have to suspend distributions or reduce your
Yeah.
distributions or something, and you have to say exactly, oh, this is what happened, but it happened months prior.
And I've been
people are saying,
lying. Yeah. Yeah.
why is the first time I've heard about this? This
Yeah.
all didn't just happen in a month.
Yeah.
Versus like, hey, there's some supply coming online in the market. We're having a hard leasing is slowing down. This is going to be a slow quarter and probably a slow year, just
Yeah.
to let you know. And then you can say in your next words, like, occupancy, we've maintained,
Mhm.
but, or, we've declined a little bit in occupancy. As expected, this is going to be a slow year. This is what we're doing. We're increasing marketing.
Yeah.
We've actually reduced, our rent growth a little bit to try to get occupancy up a little bit,
Mhm.
whatever the plan is, but just keep up to date and being proactive.
Yeah.
Our delinquency is up. We're not collecting all the money, but this is what we're doing. Okay. Next month, well, delinquency still isn't good, but these are the things that we're doing. Next month, delinquency still isn't good. We're trying something different.
Yeah. Yeah.
Versus, why aren't you distributing? I'm not hearing from you. What's going on? And they're like, well, actually, we've had these issues. Versus,
Yeah.
this is the problem. This is the solution that we're attempting, and then
Mhm.
we're gonna update you. These are all real, true stories for the most
Yeah.
part.
Yeah. And not the least of which are the ones where the ship is sinking and the captain says everything's okay, and then they're drowning because every time
Yeah, we've heard that a lot.
and every time it's almost like at a certain point, it's not a lie of omission, it's a straight up lie. Like, and so you have to say, not only is a deal bad, but I've kind of been lying to you too.
Yeah.
And you want to avoid both of those.
Yeah. It's
But
hard to invest in somebody who's been lying to you. So, Matt, we've given a lot of anecdotes and context. What are some of the takeaways
okay,
from
yes,
Paul Fiorilla's
really,
this piece on loan maturities?
really, it's
This is a good update because
yeah, really good
we put
update.
out reports. And,
Solid. Like if you want a primer for how multifamily maturities, multifamily loans, and even distress, what things look like right now, look no further than this report from Yardi Matrix, where it gives a breakdown of lender types, origination years, years of maturation for multifamily loans. And, on page 2 there, it just shows really lots of loans are coming due in 2025. Um, especially, especially GSEs, which is the biggest group, but commercial banks have about a third of the volume of the amount of loans outstanding, in maybe a little less than a third in terms of the total amount of loans. And from there, it's HUD loans and local governments, life insurance, debt funds, CMBS. The upshot to all of this is the most of them are these are the GSEs.
yeah, which is Fannie and Freddie.
Yeah.
Yeah.
These agency loans. And I was surprised that the real increase in maturities is expected in 2025, not necessarily in 2024. And you can see the originations and how they have spiked in 2022. And so I guess, 2 years after that, 2024, it's an easy an easy calculation for bridge loans or whatever. But lots are coming in 25. And
Well, so much of this has to be kick the can down the road. Is meant, two points. One,
Mhm.
Obviously 2021 was a big year, and also there was a major surge in transactions at the end of 2021.
Yeah.
Looking at CoStar data from our reports, that's where I think that the peak. I thought the peak was actually in Q4 of 21.
Yeah.
Continuing through the first half of 2022,
Good point.
it was end of 2021. First half of 2022. So, 2 years, that still puts us in 2024. So a lot of these have to have been loans that have been extended.
Yeah. Yeah, I remember we talked last week about how much of the portion of multifamily loan maturities that are expected in this year, or really the next few years, have been extended before. And I expect that it's more than is reported, that these kind of things may shake out a little differently because it's not exactly measured with a perfect precision.
Yeah.
The next page does have some great information about these yearly maturities. So we have this year, the volume is expected at what is it, 61 billion, maybe let's call it 62 billion. And 2025, it jumps up to 84 billion. In 2026, it's to 89 billion. That's a lot. And not only do they have
this is these, a lot of 5-year loans and 7-year loans from GSEs are probably maturing in this period.
okay.
And again, like maturities, so this is not all of these loans will go to maturity. A lot of loans don't go to maturity.
Okay.
Because you're going to sell it before that. You
Okay.
put a 7-year loan on it on a deal, but you sell in year 5.
Okay.
So like a lot of these that maybe are maturing. But if I had to be a betting man, I would, if interest rates do come down,
Mhm.
a lot of this debt that was originated in the period, especially if it was a little bit higher interest rate,
Yeah.
will be refinanced
Okay.
in this 26 to 28 period.
So if
kick
you're
that can
buying,
down the road.
and you and they have a better loan than you can probably get, you can assume the loan. But is it typically what percentage of a deal, just offhand, how usual is it that you assume the loan from
the current loan?
Yeah.
I don't know the percentage. I would say it's
Is it usual or unusual? I guess.
it's not unusual.
Yeah. Yeah.
I wouldn't call it a tip. I wouldn't call it
Okay.
always
Yeah.
by any means. Maybe 10 to 20% of the time,
Okay. Okay.
something like that.
All right.
It's less than 20.
Yeah. Yeah.
Could be 10. Could be less.
Because there's a lot of factors, I guess. It's not just the interest rates, how many years maybe left.
I mean, we've
all the other
assumed
kind of
a handful of loans.
Yeah.
So just again anecdotes, but it definitely happens.
Okay. Okay.
Assume more than one, and we see assumable deals all the time.
Okay. The other piece of information here on the same page is what I think kind of really adds to it, because we've looked at ourselves. We looked at the timing and the type
Yeah.
and the amounts and all this, but this looks at the place.
Yeah.
So which metros are have the most loan volume maturing? And I'm pulling out Atlanta right here because it tracks a little bit. Um, lots.
Ground zero.
It could be ground zero, and in the subsequent pages, they have these the amount of loan volume maturing, and they also compare it with rent growth for a given year, like 24, 25, 26. They have these little, like a scatter plot of them. But I really like this paragraph about distress. And before we get into those charts, he does note these factors that will lead to distress. Nothing that we are unfamiliar with. Things like interest rates, loan extensions, secondary debt markets. We've all just talked about that just now. Property fundamentals, regulatory issues, and loan seasoning, which is to say, are you on the tail end of a decently performing loan, or are you in a new, is this a new spot where you don't really know what you're doing?
Yeah.
But I like this paragraph, kind of sums things up in when it comes to distress. He says, Paul Fiorillo, that is, he says, consequently, distress is likely to be higher in value add properties acquired with aggressive rent growth assumption at low yields and or financed with short-term debt in 2020 to early 22. A record 45 billion of collateralized loan obligations were issued in 2021, with 28 billion backed by multifamily properties. And then he said a recent report by Morningstar said that the rate of CLO loans that are 30 or more days delinquent rose 285 basis points to 6.2% at the end of 2023, and that number is likely to continue trending upward. It is interesting. It's something that we said too. It's not going to be the pretty, beautiful properties that have the distress. It may be the ugly ones, and these uglier properties. I've mentioned this before. Right now, the market is not seeing distress as distressing. It's seeing just the opportunity in distress. And so that may be a place for people to look. Now, if we're talking about places, we could also look at markets to look. And that's where I also thought was interesting. So yeah, his point about the value add, that's really an interesting type when it comes to asset types. But the real value add for this report is the information they have about the markets.
You're gonna have to go there to find the deepest opportunities. You're going to have to maybe, get ready to put out some fires, and like literally you're going to show up to a dumpster fire and be ready to jump right in. But, if the dumpster's cheap enough, it could be a great opportunity.
And some of these markets that you see right here it's not the markets are far from dumpster fire markets, but they are the markets with lower rent growth in the past year or two.
Yeah, exactly.
But they're all Sunbelt. So that long term, there's probably going to be population growth, job growth, rent growth going down the line, unless people just keep building there willy-nilly.
The thing is, there's going to be a lot of investors who do just get burned from multifamily throughout the next year. Because again, having all these conversations, people are going to lose money, and people were, who is seen as multifamily is, a recession resilient. And, we didn't it's not a recession. It is a recession. It's kind of a asymmetric event, but people are not going to be too happy. They're going to feel like they thought it was a safe investment.
Yeah.
Because it was sold to them as a relatively safe investment. It's going to turn out to be a little bit more risky, although, there's always risk in anything.
Yeah.
But, Atlanta, Matt, here, all the way out here on the far right, and we're looking at loan maturities and also rent growth. It's got negative rent growth, and it's got a lot of loan maturities. Also, Atlanta, man, it's bad. We don't have any deals in Atlanta or anything like that, but the amount of collections it's rough.
Yeah.
I mean, they have such a backlog of evictions. Because the eviction moratorium in Atlanta, for whatever reason, lasted just much longer than it ever needed to. And politics in Atlanta have made so that really no one was kicking anybody out. No one was being evicted. It's hard to evict anyone in Atlanta. People are allowed to stay for longer and longer. Then there's also a law that you have to have an actual marshal be present at the eviction. And so, but there's not enough marshals. And so even if you get the court order, you don't have the person to come and actually evict the person. And so there's a huge backlog. And talk to some investors who see that maybe as an opportunity. Okay, the idea is that now the courts are moving a little bit faster. They're kind of getting through the log jam, and maybe you buy something that people are tapping out on because it's just been too stressful,
Yeah.
not working, ready to just hand back the keys and you can buy it at a discount. But again, you're going to be coming into an environment in a property where no one's been paying rent and no one's been able to be evicted. And
Yeah.
that's a good luck changing that culture and demographic.
Yeah, that is interesting too. And I wonder how much it is connected. I mean, Atlanta's so big in terms of like its population, but it sprawls out a little bit more than
Yeah. I'm
than
talking
other metros.
specifically Fulton County
Okay, okay. But
for those issues.
yeah, that's we covered the eviction moratorium, well, it's like 2-3 years ago, and how
There's still, when then someone said eviction moratorium, I was like, that's a thing. That's a thing still.
yeah, and I even a few weeks ago, we may or may not have covered this on the report, but evictions are still lower than they were pre-pandemic. So and that may be evictions winding down, but there hasn't been a backlash as these laws have gone off. It hasn't been like, oh, I was getting ready to evict all you guys, and now I'm ready to.
Yeah.
It seems to be
I need to
normalizing and
look
not.
at, I need to look at those statistics
counteracting.
because my feeling is that evictions are a little bit higher than pre-pandemic, but I could be wrong.
Yeah. Well, anyways, kind of back a little, just kind of close the loop on this is, yeah, it does seem like Atlanta has a lot of loans, a lot of vacancies, lower rent growth, but also markets like Austin are also up there when it comes to the amount of loans and the softer maybe fundamentals. Places like Nashville as well.
Yeah, I mean Austin, Vegas, Atlanta, Houston, Phoenix. They're all for in terms of vacancy, all really high, north of 7%.
Yeah, and all of them 15%, at least 15% or more of loan volume is maturing through 2025. So,
and look at New York,
really, really low.
really low. Yeah,
Wow.
yeah.
Well, so that's you can look into the report to see other ones. They've got graphs here for 2027. They've got more information about the lender types and other information. Really great update though from Yardi Matrix.
Yes, really great report. Now, lastly, Matt, on the great report, we have a piece from the Harvard Joint Center for Housing Studies. It's called "Power to the Neighborhoods: NYC Growth Politics and the Origins of the Housing Crisis." Okay, Matt, you're gonna have to bring us in. Tell us what tell us what you were excited. You were excited.
Yeah,
about
the report
this.
spoke to me. I've been chatting about this with my friends and around the office about, and maybe it was just
You've been
like
fraternizing
a little bit.
around the
Yeah.
house.
And maybe it's like obvious, but I keep thinking about this idea of the tension in housing policy between city government and neighborhood interests. Is that where the real fight is going to building more houses? Because I feel like, a state tells a city, we got to build more houses. Well, the city's like, yeah, I agree. And the nation tells the state, well, you got to build, and the state's like, yeah, okay, all right.
This is all backwards.
But yeah, I know.
The governments don't build the housing. The housing that's been built by the governments doesn't work.
Yeah, but we have to have these policies.
They're giving us permission.
Yeah,
to build. They're allowing us to build.
And so the real barrier. Yeah. So that's right.
Thank you.
Okay. Let's say the national government is like, we want these policies to increase housing, and the states are like, all right, well, give us money and we'll do this, and that happens. And then the state's like, we'll give the city money. And this may or may not happen. Then the city's like, okay, now it's time to build the house. We want to build it here. And the neighborhood's like, yeah, you may be given a lot of money to put these houses up, but we don't want them. I often feel like the biggest obstacle happens when it comes to the city trying to talk to the state, the city talk to the neighborhood. And this one, I don't know I don't know if I was way off base there with my assessment, but this article at least pinpoints, yeah, this did happen in a very big way around 1970.
Yeah, well, the 70s were a totally different time period, right? Because that's when the projects were being built, and the federal government actually had a role in housing.
So at that same time, there was almost like an unwinding of, I guess, more centralized control over this, because it talked about this unprecedented movement across American cities that favored redistributing control of urban government to neighborhoods. He calls it neighborhoodism, and it was embraced by conservatives like William F. Buckley, and as well as like Boston school integration opponent Louis Day Hicks. I'm quoting here. A distinguishing feature of this political trend was its newfound appeal to Democrats disillusioned by the New Deal model of liberalism. And this author really argues that while the subsequent shift to neighborhood-oriented policies brought much needed stability to city life, it also set the stage for the current severe housing crisis. Stability is a key thing there. Because even in my conversations, I was like, people don't like change. They don't, they want sometimes they want it a little bit better or improved, but they will vote for no change really 9 times out of 10. And that's
they
a big thing.
say they like change, but they don't really like it.
Yeah, exactly. And again, more interesting right at the outset is this implication that there could be another way. At least there was another way before this unprecedented movement around 1970. So
what is he?
He does not posit an alternative, but he does argue the implications. Sorry.
What are the implications?
Yeah. So I
haven't read this piece, by the way.
Oh, no, it's fine. It's fine. That's what I'm here for. The full working paper actually delves into things like per capita home building that peaked in the early 70s, which I think is really interesting because if you're adjusting for per capita, then that kind of factors in for the baby boom and that kind of generational need for new housing at that time. And maybe suggests that, wow, this neighborhoodism is really like anti-growth. And a point that kind of is a glaring, bitter truth in the commercial real estate industry is that often these neighborhood-centered arrangements, as much as again, like I agree, local control of government. Look, you should be able to determine, what's happening around you, but ultimately, it ends up with these neighborhoods like being ambivalent. They either don't care about growth, or frankly, they're just like against growth. And especially, the author cites, here's a quote, laws and implement processes that slowed the pace of growth by requiring neighborhood input in the real estate development process. I'm picturing committees and meetings, maybe they're at 7:30 p.m. in the neighborhood organization, and like 12 people are complaining against the apartment being built. And then the project's canceled. And that is probably what started to happen throughout the country in some form or another. But what's made clear here is that this way of thinking about neighborhoodism is persuasive for liberals and conservatives. And while the article, again, hints at another option, doesn't really give it, but one thing that I'm really thinking about here is this spatial component of NIMBYism, for lack of a better word. So not in my backyard. Yeah. Okay, so how far is your backyard? How far do I have to get from your house in order for you to be happy about, or in order for you to not care about an apartment building getting there? And finding out, even if it's like the amount of feet, the amount of miles, the amount of city blocks, getting a discrete number for that would be really interesting and could maybe work towards compromise. Although probably I'll just say no matter what.
Well, it comes in this whole premise is it should be the neighborhoods that are making decisions. I think that frankly the author has got the whole premise is it's interesting, but I think it's a little bit backwards.
Yeah.
Because this idea that the federal government or any government is saying, we should build housing and that's how housing gets built is just not the way that housing gets built. I mean, there was a brief period of time where the government built some housing projects.
I may have been misphrasing it, sorry.
But I'm just saying that a lot of this is, but furthermore, this comes down to property rights and private property, and not that you don't need to have some community buy-in, but if you're not going to be infringing on the rights of your neighbor, immediate neighbor, what rights does that neighbor have to tell you what you can or cannot do? And then it comes down to build a duplex, assuming that it's within like the zoning laws of that community, which the zoning laws are the problem of, does it facilitate, because developers, they want to build, but they're looking at, how do I build this? What are the incentives? And that's where the government can play a role of, creating programs that kind of incentivize of, hey, we want more affordable housing.
Yeah.
We're going to give you some subsidies to build affordable housing.
Yeah.
You make it work. You're going to do all of it. You have to make it profitable and a sustainable business. Obviously, there's a lot of benefit without, so if you can do something without subsidies, it's a lot more sustainable than with subsidies
Hmm.
because, if you get reliant on subsidies, it's hard to
Yeah. Yeah.
sustain that. But the reality is for rents to be low enough for people to live somewhere, you have to you either have to, there's two choices. The first is just you don't regulate it at all and you let people to build as much as they want,
Hmm.
which you have a lot of supply, and that means all rents come way down,
Hmm.
which I think is the real solution, but it's just too scary for everyone to
Yeah.
acknowledge. Or you highly subsidize it, and no one even, and you highly regulate all housing construction, and you subsidize certain types of housing that you want built. So all housing is really expensive to build.
Hmm.
All housing is really is expensive in general, and then you have a special program to make developers really rich, so they can build
Yeah.
housing
Yeah.
that
Yeah.
people that are below a certain income level
Yeah.
can afford. And so what you end up doing is you have a worse housing crisis
Hmm.
that's, bottlenecked through the
Yeah.
government
Yeah.
because they're limiting at the local level and, they're trying to subsidize at the federal level.
You
And
should.
and those the two
You need to call
divergent.
the author because that's the concluding paragraph that I was missing. Is like, well, yeah, that's a natural follow on for the kind of the implications of this is, well, what are the options? What are people presented with? It's either, more government control, over, who, where, how things get built, or you're opening things up and you're allowing people to make more decisions, kind of a deregulatory thing.
Yeah, I think if you open things up, I think you'll find over time that you'll be less reliant on subsidies.
Yeah.
In the immediate time, because we need people, we do have an existential crisis in the United States. I
Hmm.
think we do need to continue to subsidize building housing of all types, but especially affordable housing. It really could be of all types.
Yeah.
Best way to do that is just get rid of rules and regulations. The more of that, you're going to see more building.
Hmm.
You're going to see more units, and we're seeing we're seeing the data right now because there's a ton of new supply, and it's not affordable housing that's coming online, even though some of it's being built.
Yeah.
It's market rate.
Yeah.
The market rate, super high end luxury apartments are lowering the rents of the B and C class apartments. It's flowing through the system, and it's all due to builders just being able to build. Let's just allow them to be able to build.
Yeah.
Let people, if you have, again, without infringing on someone else's rights,
Hmm.
and hopefully the zoning laws are reasonable, conform to the zoning laws, make the zoning laws reasonable,
Yeah.
and get out of the developer's way.
I think
and
that's
and if you're a local community or federal, subsidize some stuff that you want to build, but don't tell someone they can't build something.
well, and that's, I think that one of the big things is how zoning is and like the historical artifacts of all these zoning laws
Yeah.
and that are making it so that you can't build apartments because it's been zoned for single family. So if you want,
Yeah.
and let's say you buy up or there's like an empty lot there and you want to build a moderately sized apartment building there, and now you want to get it rezoned, everyone's going to disagree with you. And so what I would argue is like maybe it is a little bit maybe let the guy build the apartment building.
Let
That's
the
what
guy
I'd
build
say.
the apartment building. Now, the zoning isn't. It's important though. So
Mhm.
here's the reasons how you can infringe on other people's rights. You have to be
Yeah.
careful for. And so you have to have enough parking.
Yeah,
Like
yeah,
you can't.
yeah.
A 100-unit apartment community in a little neighborhood. Where are people going to park their cars?
Mhm.
You have to make sure that
Yeah.
you're not.
And we
completely
said before,
clogging the
yeah,
street.
you're right. You're right. That's a good point.
The offsets, making
Mhm.
there are some guidelines that that you're going to be interfering with society, that you're going to have
Mhm.
to hold up to these measures. But the idea of, we want to pick out your colors and
Yeah,
the
yeah, yeah.
facade and, a little bit architectural elements so matches this other building down here. Just let humans create and be creative and build and engage in commerce if we're not impacting somebody else in an adverse way.
And when I was talking
It's
about
oversimplified.
no, I
There's
agree.
nuance that I'm
Because
not talking about,
otherwise
but-
and just like you said, it would only benefit the really wealthy, really wealthy builders. I think that so what my friend was calling these developers with FU money. So let's say you have FU money, you can wait. Not only can you work with the government, you get those subsidies, that'd be nice, that benefits. Or on the alternative, if we're going the regulation route, and and you try to fight against regulation, you'll just go to those meetings. Someone will complain, you'll be like, oh well, all right, and you'll wait them out, and you'll wait them out. and eventually they're going to get something that kind of goes against their interests
Yeah, well,
because
they're
you've got the
gonna
resources.
yeah, well, they're gonna build somewhere else.
Yeah,
But
yeah, that's true. They can always build somewhere
yeah,
else
they're
too,
like
right?
this isn't
Yeah,
worth it. You can't get in, and
yeah.
then that helps the insiders, the politically connected who
Hmm.
can get approval because their buddies are on the zoning board, and so the rich get richer because they're connected. They
Hmm.
get the thumbs up. They're gonna get the tax credits because it's a political process. They get the tax credits awarded to them.
Hmm.
They cash in on a huge development fee, so they're making $1 million. Before the thing's even delivered, before any individuals, have rented an apartment.
Hmm.
And so, it's a great thing. Someone has a relatively affordable place to live. But I think that if we looked at it, if someone was like, I'm for affordable housing, which I am, but you said, okay, we're going to provide 200 people with an affordable rent that is in line with what they make,
Hmm.
and to do that, we are going to give this developer $10 million.
Okay.
It's like, okay, that's great, but like it doesn't seem like the most efficient like system if we're having to provide, if there's $10
Yeah.
million of drag
Hmm.
of money. Like, do you think is that an efficient system?
Well, not necessarily.
It's kind
No.
of the best thing we've got.
Yeah.
And I'm not really saying that there's a better alternative than, the LIHTC program. It
Yeah.
is the best. And people are putting dollars at work and they're taking some risks and they're building affordable housing. That's a good outcome. But like it's a but just be clear,
Yeah.
it's a subsidy for the developer as well as for
Yeah. Yeah.
it's an incentive for the developer.
Hmm.
It's like, the rich, we talk about welfare. Well, it's how the rich are,
Yeah. Yeah.
on the government
Are
dole
you
as well.
kind of suggesting that maybe it could be like it's almost like encouraging you don't have to really work that hard. You got that $10 million extra.
Well, they overfund the projects too. They
Yeah.
spend crazy amounts of money on things.
Yeah.
It's not like they're, obviously you want to build good housing, but like they're like, oh, we've got extra money. Let's build this. You have to spend the money.
Yeah.
And so they're like, let's just, okay, we've got 50,000 extra dollars.
Hmm.
Let's build a sign,
Yeah.
the
Yeah.
nicest monument sign of all time.
Hmm. Hmm.
Or this. So it's not like let's build some more affordable housing.
Yeah. Yeah.
It's just not, I think it's not a super efficient way of using taxpayer money,
Hmm.
but it's the best program that we've ever come up with
Yeah.
to incentivize to build affordable housing. The best program, which it's bipartisan, is to ease zoning
Yeah.
laws and regulation and just to allow more construction of all types of housing
Hmm.
in general. And the most that's going to be built is going to be market rate.
Yeah.
So just
Yeah.
get out of the way of the market rate folks. Make sure they got enough parking. Make sure they're not going to ruin a community, but
Yeah.
don't start picking up paint colors, and let's get it done.
Yeah. Agreed. I can't rebut that. It's too much. I can't wrap my head or I can't wrap my head around like a simple solution for this kind of two-tiered affordable market rate division between housing. I don't think we're getting rid of affordable housing anytime soon, and I don't think that it is too much of a drag on market rate. However, regulation seems to be a
No.
big barrier that both sides of the aisle, just like both sides of the aisle in the 70s, seem to kind of come together against for like neighborhood control. Now both sides of the aisle are like are waking up to the power of deregulation as a tool for providing more housing.
Yeah.
I just want to
agree.
know how far away from your house can it be before you get mad about me building the new apartment building.
I, it's anyone who can show up to the meeting. That's the thing with these
Yeah,
meetings.
yeah,
It's not
that's a
like
good
you always
point.
have to
Yeah.
like register. I
Yeah,
mean,
yeah.
I remember a mosque was going to be
Mhm.
built up in Carmel,
Yeah.
and they had a Carmel town meeting,
Yeah.
and they had to move it to the gymnasium because there was like 1,000 people that wanted to show up to
Wow.
the meeting
Yeah.
about people building a mosque
Yeah.
and concerns about that.
Yeah.
Which I'm really sure what the concerns were, and the only legitimate concerns people had were like traffic,
Yeah. Oh,
and
wow.
it's like 1,000 people showed up for traffic.
Well, and this is just
Their
personal.
land, can't you just let them build
I
their
know someone that was running for the city council. He won his seat. And he's the number one issue. Everyone talking. He went door to door, pretty much talked to everyone. Housing.
Mhm.
They don't want apartments going up in their district,
Yeah.
and it's the same everywhere. I guess
Yeah.
you can't get away from it.
No.
Suburb, city, whatever. Got to live
Yeah,
somewhere.
you gotta live somewhere. You have to have a roof over your head,
Yep.
or it'd be nice too. All right. Well, thanks for watching the Gray Report. Make sure you like and subscribe to the Gray Capital YouTube channel. Click the bell icon. You're gonna get notifications. And then again, if you're a credit investor, you want to take a look at our new offering. It's River Club Apartments based down in Evansville, Indiana. Again, you have to be an accredited investor, and this isn't a specific offer to invest, but hop on over to graycapitalllc.com and you'll see a little button. Press it, get the information, set up a meeting with the team. Looking forward to talking to you soon.
Sweet.
Got anything, Matt?
Yeah. I
No,
nothing.
nope. He's got nothing. All right. Have a good one.